Silver Forecast, SF Desk Brief. Sunday, February 1st, 2026. Good morning. This is the Silver Forecast Desk Brief. Friday's silver price drop was sharp and violent. Paper prices fell hard. Physical prices pulled back as well. But here's the problem. A sharp paper price drop cannot coexist for long with shrinking physical supply. One of those conditions has to change. Either physical silver returns to the system, demand breaks, or price discovery resumes to force balance. So far, we are not seeing the first two. That's why today's question is not about price. It's about availability. And availability did not improve. Silver is down, but that's not the story. What matters this morning is where physical silver is leaving the system, and where it is not coming back. Over the past week, both Western and Eastern exchange inventories have continued to decline. Not rebuild. Not stabilize. Decline. That tells us this move is still being driven by consumption and withdrawal, not speculative rotation. Let's walk through it. Start with Shanghai. Silver warehouse stocks declined again into the end of the week. Multiple warehouses reported drawdowns. Total on-warrant silver fell meaningfully from earlier in the month. That matters because SHFE inventories represent real metal behind active industrial demand, not paper positioning. When Shanghai inventories fall even after a sharp price move, buyers are not backing away. They are accepting volatility and still pulling metal. This is not liquidation behavior. This is through price demand. Now look at comex. On comex, both registered and eligible inventories continued to fall. There was no coordinated restocking, no sudden inflow, no sign that metal is returning to the exchange system. That's critical. When Shanghai and comex decline at the same time, silver is not being shuffled. It is leaving the system. That is a structural signal. In a healthy market, higher prices slow demand. Inventories stabilize. Warehouses refill. Pressure eases. That is not what we're seeing. Instead, we're seeing volatility alongside shrinking buffers. That tells us the visible paper price is still lagging the physical clearing price. Paper markets can print contracts. Warehouses cannot print metal. When inventory falls while price whipsaws, pressure is not resolved. It is pushed forward. That's why volatility is expanding instead of calming. And that's why pullbacks fail to reset structure. They relieve positioning, not supply. Confidence is not rotating into bonds. There is no evidence monetary stress has found relief. And there is no evidence physical buyers are stepping back. If this were a speculative spike, inventories would rise. They are not. If this were a temporary imbalance, metal would return. It has not. That absence is the signal. Here's the framework going into the new week. There is still a 30 to 35% chance of a short-term pullback. That requires one thing: a visible pause in physical withdrawals in Shanghai or on comex. We have not seen that. The more likely path, about 60 to 65%, is continued pressure with volatility. That does not mean a straight line higher. It does mean price discovery is unfinished. And as long as physical silver leaves warehouses instead of returning, pullbacks remain positional, not structural. Friday's price drop did not fix the silver market. It tested it. This market is not being driven by belief. It is being driven by availability. And availability is tightening, not improving. We'll be back Monday with the next desk brief. Until then, this structure remains unresolved.